Greetings. Welcome back to the continuing lecture in corporate finance. This is Dr. Jeff Holm, and today's topic is real options. Now, so I'm going to share, okay, I need to, I hope you're, yeah, okay. I believe you're all looking at the real slide for today's topic, real options. And actually, this is a slide starts with a discussion of about the risk. For finance, any topic in finance, risk is a very critical topic. It's a critical component in finance. Now, the risk in financial theory in finance is associated. Risk is associated with the return of a random variable and their probability distributions. So, in other words, in Finance 100 or in Principles of Finance, we also discussed. We also, talked about this topic as well, return versus risk, right? The return to any return on financial instruments, the risk is the uncertainty of getting the predicted or expected return. In other words, the variability or the variance in the possible returns, right? That can happen. But, the possible returns are, of course, the random variables, because, it's not always going to be, it's not going to be the mean return or the expected return, but it is basically a random variable that can happen, right? Regardless of what the predicted or expected return is. And if you think about it, the cash flows from investment projects are random variables, right? Hence, we define the risk this way: the chance that a random variable will take on a value significantly different from the expected value, right? We already talked about that. In capital budgeting, the estimate of each future period's cash flow is a random variable, of course. We talked about it. And the net present value and internal rate of return are random variables with expected values and variances that reflect the risk. And this is something we already talked about. Actual values may be different from the mean. The amount the actual value is different from the expected is related. The expected mean is related to the variance or standard deviation. In other words, the average of those, deviations is called the standard deviation. And we all, we understand the concept of, distribution, especially the normal distribution, right? This doesn't. This is roughly, normally distributed, but it's rather the kurtosis, or the height, the kurtosis is slightly or the by this alone we cannot tell whether it is tall or short, but the distribution is relatively more dense than normal distribution. I mean, just from graphic the characteristics of it. Now, of course, the reason we are introducing the concept of risk is clear, because the cash flows are a random variable, because it has the it's not a point view or point estimate. It is an interval estimate, right? In other words, the values can be cash flow at time one can have distribution between something, like negative, like tens of thousands of dollars to the positive tens of thousands of dollars, and everything else too. Now, so this is once again, the raise of what I just said. We have been treating cash flow as if they are point estimates. In other words, it's a point value, given point value. But in reality, actual cash flows are estimates, right? In other words, it's an estimate that has a range of potential, right? So it's got a potential range of possible values, right? So wrong decision by using point estimates for NPV. That means, we can reach a wrong decision, right, by using a wrong point estimate. So, first of all, everybody wants to avoid risk, right? I mean, if possible, right? And if it is inevitable, we all prefer less risky projects than to riskier ones, right? Ceteris paribus, meaning, all things equal, right? That's Latin for all else being equal, right? Managers prefer less risky projects to riskier ones. That goes without saying. And especially if the mean return is the same, nobody will. Let's go back to this. If the mean return, I mean, in this case, this has 13 million mean, this has 12 million mean, right? And these two projects, but if they have 12 million, the same mean, right? If they both have same mean, right? Nobody would prefer this, because it's got wider variance, right? In other words, potentially you have the chances of losing or getting lower returns, right? Lower, cash flows, lower value. And in this example, if if they both have $12 million net present value, project A has much smaller variance, meaning you have less chances of getting lower net present value, right? Of course, project A also has lower, smaller chances of getting higher return. What can you do? That's what it is. But this is less risky, and this is riskier, quite, compared to project A. And the nature of the company depends on it's the process it is undertaking, right? A company is actually a portfolio of projects. Think about it, isn't that right? Tesla is, a good example. Of course, Tesla is a car company, automaker, but and they have, but under the same umbrella, they have Tesla, they have SpaceX, they have Boring Company. Boring Company is a company that makes, that builds tunnels, right? Boring tunnels, right? For the uh, hydro, what do they call it? Hyper hypertube or hydro. They're building, super fast, hyper fast um, transit system. Using by building, underground tunnel, vacuum tunnel. So the capsules that go in, they use that capsule as a shuttle, and it's like sh- uh, placing the shuttle in the tube, and the tube is vacuum. So, or electromagnetic. I don't know about the actual technology being used, but if it is vacuum, so it's like sucking the tube to the destination, right? And so they travel like between LA and San Francisco in like 30 minutes or something like that, right? So if you think about it, although they are different companies, but they are all under one umbrella. Elon Musk is the chairperson of the holding company, right? Who 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 holds majority shares in each of these companies, right? So it's practically like a conglomerate, one conglomerate with different divisions under it. So if you think about it, they have uh, the holding company of SpaceX, Tesla, and that Hypertube. They all have. They're just like um, the holding company is like uh, diversifying its uh, portfolio through different projects, right? So anyway, undertaking a new project while ignoring the risk. I mean, if you're taking on a new project, you have to consider the risk. I mean, if you ignore the risk, right, um, it changes the firm's fundamental risk characteristics. So when you're adopting a riskier project, um, it will make the company riskier. It goes without saying. So it raises the beta of the company, and with higher risk, the stock price would decline. And you might wonder why. Well, when there's a higher uh, beta, then the discount rate or the required return, and or also called cost of equity, will have to go up, right? And as the discount rate is higher, the price of the stock should go down. Now, um, so we know how they incorporate these risks into capital budgeting. We talked about that in the capital budgeting, right? Now, and as an example, we can how we incorporate this risk. As an example, first, we can use a very basic uh, scenario, right? Or sensitivity analysis, scenario or sensitivity. First of all, this is more, it's better to call it scenario analysis, because sensitivity analysis would normally refer to something else. Now, so we can think of in this capital investment project, right? we can now in capital budgeting we only assumed, cash flow at time 1, time 2, time 3, all just predetermined numbers. But once again, we already understand that it's not a point, it cannot be a point value. It will have to be a range of values, right? So that means there can be a range of values depending on different scenarios. And a very obvious scenario is the worst case, likeliest case, most likely case, and the best case scenario, right? Of course, the more rational scenarios would be like severe recession, mild recession, right? A normal economy, and economic boom. Those four scenarios are at least more natural because the economy can, depending on the economy, right? The economy can turn out to be normal, just regular, growth, right? Regular, growing, the economy growing at a regular rate, regular growth rate, or the economy may be facing a severe recession. In that case, the growth of the economy may be even negative, or some mild recession, or an economic boom, in which case, growth rate would be very good. So under those different scenarios, we can project, we can make a cash flow estimation, right? Under these different scenarios. So we can have three different. So first, on the worst case scenario, C1, cash flow at time 1 would be 450, most likely 550. And then best case 650. C2 also under those, right? And then we analyze the net present value under each scenario. Worst case scenario, most likely case scenario, best case scenario. We will have three different net present values, right? So here's an example. Net present value in the worst case, now that will be negative, right? And we run the same net present value calculations. So in the most likely case, 312, and this would have to be the best case. And best case and most likely 101, right? So, but once again, these just three scenarios are very, very simplified. It's a simplistic assumption, right? Reality would be quite different. So how do we reflect reality? So we use, computer simulation, and the computer simulation is called Monte Carlo studies. Monte Carlo studies is just a statistical simulation, right? Monte Carlo studies, right? Make assumptions about the shape of each future cash flows probability distribution. And then computer draws random observations from each cash flows distribution and calculates an NPV outcome. And then sort the outcomes into a histogram of NPV net values, histogram at present values, probability distribution. You will see what I'm talking about in the next slide. So this is what I'm talking about. So the Monte Carlo simulation is having the computer run numerous simulations, right? And then see how many times these results how many times these results came out. So, for example, $100, and I believe everything is in $1,000, thousands. So it's 100,000, 200,000, 300,000, 400,000, right? This is negative 100,000. 100,000 was observed almost, this result came out almost 600 times, 500 times, 400 times. This would be like 250 times, 150 times, and this would be like 50 times. But you can tell the distribution is, it shows slightly normal distribution pattern, but, of course, it's skewed more to the right, right? Relatively, if it is, this is not perfectly symmetrical, right? If it is perfectly symmetrical, then you would have also like, negative 200, negative 300, right? And you would see more bars there, but you don't see anything below a negative 100. So this Monte Carlo simulation, so this is more likely to be mean, right? So in this Monte Carlo simulation, you don't have extreme loss, right? Rather, your upside is, the chances of you have more probability of hitting the upside rather than the downside, right? Okay. But what's the downside or drawbacks? Now, the probability distributions have to be estimated subjectively. So this is rather this is not totally a random simulation. I mean, if it is randomly designed, if the simulation is randomly designed, then it would be, this doesn't have to be assumed. In other words, in this case, you are using a certain, pattern of distribution, probably based on your past experience. Because you see, in this histogram, you don't see like deep loss, right? Like, but how can it be the result of a random simulation? I mean, if it is a random simulation, don't you think, as I said, there should be more left tail, right? More left tail, but there's more right tail in this distribution and less of the left tail. And this is why, because the management is using their subjective distribution, pattern of shape of distribution from their own past experience, right? If they didn't do this, if they didn't pre-designate or determine the pattern of that distribution, then the pure random simulation would give you more symmetrical result. Okay. So the management's insight or from the experience, right? If that is one of the drawbacks because you are not using completely random simulation, right? Now, project cash flows tend to be positively correlated. Yes, that's what you saw. Hard to estimate the extent of that correlation. Interpretation of results is also subjective. Um, so I'm not saying Monte Carlo studies are biased. I mean, as I said, if you completely use, random simulation, then it won't be biased. But they want to make it, uh, reflect more. They want to make it to be more reflective of their past experience. So uh, they set the parameters, and so the parameters would uh, be more like reflecting uh, the uh, the patterns of the management's experience in the past. Okay. Now, next is then if you can um, um, generate probability distribution through the Monte Carlo simulation, then the next step is to build a decision tree. Now, decision tree is a tree diagram that approximates probability distribution of a project's net present value by estimating the probability of certain events in the project. And the decision tree, a decision tree is a graphic representation of a project in which various events have multiple outcomes, each of which is assigned a probability. So better, to jump into the actual sample than, just the verbiage. So this is a decision tree, of course, right? A very simplified two branch decision tree. So what this is telling you is, at the beginning, right, there is a cash outflow, C0, right? This will be cash outflow. And then there will be, at the end of year one, there will be cash inflow, C1. But then in year two, there are two possibilities. In other words, possibility one is, the business does well and the project does well, and there will be a higher cash flow, right? In year two, higher than and that continues into year three. In second possibility, right? Um, cash flow in year two would be low, and the low cash flow would continue. So then there must be probabilities of these events happening, right? P1 is actually the probability of high cash flow in year two and three and on, and that through Monte Carlo simulation or from the management's past experience, they may assign like 60% probability of this path, right, or this branch, or then this must be 40% probability, right? Makes sense. That's basically what it is saying. It's an expanded timeline branching into alternate paths whenever an event can turn out more than one way. Branches separate at nodes, right? That's a node, right? That's a node, node 1. Any number of branches can emanate from a node, but their probabilities must sum to 1. Of course, all the probabilities, if you sum all the probabilities, they will add to 100%, right? Or 1. A path through a tree begins to the left. Start from the left and moves to the right, taking a single branch out of each node. Okay. So here's an example. The Wingfoot Shoe Company is considering a 3-year project to market a running shoe based on new technology. Success depends on how well the consumers accept the new idea and their demand. So, demand can vary from great to terrible, but for planning purposes, management has collapsed the variation into just 2 possibilities, good and poor. Good, right? I mean, in reality, it could be excellent, right? Actual, um, actual, demands can vary between, excellent, great, right? Good, uh, fair, and then, poor, terrible, right? Or, something like that. But, they, just for simplicity, will consider just, a good and bad or good and poor, right? And the market study indicates that there is a 60% probability that demand will be good and a 40% chance that it will be poor. It will cost $5 million to bring the new shoe to the market. Bring the new shoes to the market. So $5 million is the C0 initial investment. At cost of capital of 10%. Of course, this cost of capital is weighted average cost of capital, right? So that's the weighted discount rate. At cost of capital of 10%, cash flow estimates indicate $3 million per year for 3 years, right? At full capacity if demand is good. So that means C1 will be 3 million, C2 3 million, C3 3 million, right? If the demand, there's a 60% probability that demand will be good. If demand is poor, then 1.5 million a year, right? And there's a 40% probability. So then how do we analyze the project using the decision tree? So this is the decision tree, right? So initial investment, 5 million, right? Of course, that's negative because it's cash outflow. And then, right, 3 million, 3 million, and 60% probability. 1.5, 1.5, 1.5 million, 40% probability. Then, if with the 60% probability, what's going to be the net present value? And with 40% probability, what's going to be the net present value? And the calculation is simply the weighted average, right? How do you get to so if you calculate the present value of all of this, net present value is going to be 2.461. If you calculate the net present value in the lower bottom branch or lower path, then it's negative 1.27. But there is a 60% probability of this, right? And then 40% probability of this. So if you multiply these two, then multiply this by this, the product of those two numbers will be 1.46476. Product of these two numbers is this. So if you add them up, that is the weighted average net present value, right? So expected net present value is positive. But it's like, not even 1 million, but, it's better than nothing or better than negative, right? The decision tree explicitly calls out the fact a big loss is quite possible, although the expected net present value is positive, right? In other words, the mean of the net present value is still positive, right? what if we are what if we have more complex situation? Because in reality, it's not that simple. It's not like just 60% probability and 3 million through and through year one through year three. It's not that simple. In reality, the situation would be more complex. So here, it looks more like this. And still, this is a very, this is a rather simplified and typical, right? So after one, right, there's a certain probability that is gonna year two cash flow would be good and high, and also certain probability that the cash flow year two would be low. And then year three, there are three probabilities. It could be excellent, just good, fair, right? Three probabilities and three possible cash flows in year three. And also in the lower path, even if it is year two, this was poor, but year three, it could be good, and it could be poor, right? So there are five possible year three flows, right? So all we need to do is then, so we'll need to set it up like that, and then we'll have to we should be familiar with the concept of conditional probabilities. And conditional probability is nothing actually. First of all, for P3 to happen, for C3-1 to happen, this probability must it must be the result of this probability. In other words, but this probability is the result or the subsequent probability of this probability, P1, right? In other words, this probability is not independent, but this probability is independent, right? But this probability is conditional to this. In other words, first this must happen, and then this will happen, right? So actually, you will have to. It is a for this to happen. It's the intersection of these two probabilities, right? C3-1 is the result of these two probabilities happening one after another. I mean, that's called a conditional probability. So how do you then, find the intersection of the trends? Well, mathematically, in probability theory, this is not much different from the joint probability. In other words, two things. What are the probabilities of, let's say there is only one person in the entire class who got A. And this one person is a female. I mean, let's say, what is the probability that this person is a female? Well, then let's think about it. First of all, this is an example of joint probability. Let's say there are 30 people in this class, right? And to be that person who got A, right, you have to you have to be in the probability of 1 over 30. Isn't that right? There's only one person. And if this person is to be a female, then let's say how many people are male and female in this classroom. So out of 30, let's say 60% is male and 40% is female. If the probability of being a female in this class is 40%, or 4 out of 10. Isn't it right? That's what 40% means, right? And actually, 40% of 30 is 12, right? That means, 18 people are male, 14 are female. But anyway, 14 over 30 would give you exactly 40%. So the probability of a female, which is 40%, or 4 over 10, or 2 over 5, and probability of being getting A, the person that got A, which is 1 over 30, right? These two probabilities must happen at the same time, right? If you are a female and at the same time you got A, right? So then the joint probability is the conjunction. In other words, and, right? And is the intersection. It has to satisfy both condition A and condition B. So the probability A and probability conjunction of these two is what? 1 over 30 times, right? 2 over 5, right? Or 1 over, or 4 over 10. But anyway, if you do that calculation, that's the joint probability. But also then conditional probability is pretty much the same concept, but it happens not simultaneously, but happens subsequently. But just except for that time dimension, right? It's basically the same thing as joint probability. For example, you have a choice of lunch, right? You have several choices. For example, you can have pizza, right? You can have a sandwich, you can have a steak, right? And the probabilities of one of these, let's say, steak is, 1 over 3, if it is 1 over 3. Okay, they all have the same probability, 1 over 3, 1 over 3, 1 over 3, right? Then after the lunch, you have choice of 3 different beverages, right? Or 3 different desserts. You can have coffee, you can have chocolate cake, or you can have cookies, or let's say something else. But anyway, the probabilities of chocolate and cookies and coffee, all these, let's say also 1 over 3. Then or give some different probabilities. But then the idea is, how would you what is the probability of you having steak for lunch and then have coffee for dessert? Or what's the probability of having this and having something else later, right? So think about it. It's also a conjunction, intersection of 2 events, right? So it's like calculating the conditional probability is also like joint probability, right? So anyway, here's the more example of more complex situation. So Winged Foot Shoe Company of example 12.2 has refined this market study and has some additional information about potential customer acceptance of the new product. There are two possibilities along the upper branch. Consumer response can be good or excellent. If demand is good during the first year, right, and this means there exists, right, there exists a 30% chance it will grow to excellent in the second and third years. Of course, that means there exists a 70% chance demand in years 2 and 3 won't change. In other words, first, there was a 60% probability that the demand would be good in year 1. And then will be a 30% probability it will be excellent in year 2 and year 3. Otherwise, if that's 30% probability in year 2, that means there's a 7% probability that in year 2 and 3, the demand will be the same as year 1. That means still good, right? Now, if consumer response turns out excellent, additional investment of 1 million is needed for expansion, additional investment. If it is excellent, then you will need to increase your production capacity, right? So you will need, to expand the production capacity, and it will cost $1 million, right? Investment of $1 million in expansion. And then you can make and sell enough to generate 5 million, right, rather than 3 million in year 2 and 3. So therefore, then net cash flow for the project will be 4 million in year 2 and 5 million in year 3. You understand why it is 4 million? Because cash inflow in the year 2 is 5 million, but in year 2 you invested at the beginning, right, 1 million for the capacity expansion, right? So expansion is necessary for better financial results because since factory is currently running at full capacity along the upper path. Yes, if you're running at full capacity, there's no leeway. There's no any excess capacity for producing excess output. So you have to expand the production capacity. So then the decision tree for the project with this additional possibility is in next slide. So it will look like this. First, initial investment of 5 million, right? And then 60% probability it will turn good, 40% probability will turn bad or poor. And then in year 2, there's a 30% probability it will be excellent. And then if it's excellent, you will the cash flow will be 5 million in year 2 and year 3, but you need 1 million additional investment, right, for capacity expansion. So it will be 4 million. The net cash flow is 4 million. Otherwise, it will be just 3 million, which is just the same as year 1, right? Okay. So then, if we calculate only the upper path, right? Only the upper path. We know initial investment is negative 5 million, right? And then 3 million. But you have to find the present value of that, right? 4 million, have to find the present value of that, have to find the present value of that, right? And then you come to 4.79 million, right? And if we do it for all three, for the lower path in the upper branch and the lower branch, bottom branch, right? In each case, net present value would be like this. Now, if it is excellent, net present value is like this. Good, right? Net present value is like poor, negative. And this probability of excellent is 0.18. Where did this probability come from? Remember? 60% times 3%, 30%. 6 times 3, 0.18, right? 18%, right? 6.6 times 0.7, 60% times 70%, 0.42, right? So multiply this by probability, then becomes this. Multiply this by the probability, becomes this. Multiply this by the probability, it becomes like this. And the expected net present value will become this. In other words, weighted average net present value, weighted average, net present value is this. Expected means, this is the weighted average, right? So in this example, we can tell it's so dry. Now, the probability distribution for the project and the expected net present value is as above, goes without saying. Decision tree analysis makes the possibility of a large loss explicit. Of course, it becomes very explicit, and there's a possibility of this, but the attempt to this draws attention to risk, right, rather than just focusing on a likely favorable outcome, right? But again, it's the expected value, expected net present value that matters, right? Right. In other words, if you just plot it like this, this becomes this loss becomes so salient. It becomes so eye-catching. I mean, it becomes so so noticeable, right? Isn't that right? Of course, you can notice this too, but this hits you more, right? Because it's loss and excellent outcome. Potentially excellent outcome is relatively, belittled, or maybe this won't be this won't even catch your eyes. But actually, you shouldn't be just swayed or misdirected by the actual potential possible outcomes, but you should base your decision on the expected net present value, right? So why? Because that's with all the probabilities incorporated, right? This is what you will get. Okay. So now we will. That's the. That's like an enhancement. That's sort of like an enhancement to the existing capital budgeting techniques, and in this enhanced capital budgeting techniques incorporates the probability, right? Probably into each possible outcomes, right? So now we are moving on to the real options, okay? And in Finance 100, you all, you were slightly introduced to options as we were talking about the callable bond and puttable bond, because option is a basically stock market instrument, right? Option is a derivative, right? There's call option and put option. I don't want to go back all of this, but you understand option is a right to buy or sell, right? It's the right or ability to take a certain course of action. That's an option, right? For example, you have an option to buy this. Let's say you're leasing a car. When you lease a car, then with the lease contract, right? There's a rider. In other words, it comes along with it comes with a buyout option. That means if you like this car, and at the end, when the lease ends, then you have an option to buy it out, right? At a certain predetermined price, right? But anyway, so that's a right or ability to take a certain action, right? A real option is a course of action that usually improves financial results under certain conditions and exists in a real physical business sense. Yeah, it's not just a concept, right? Of course, it should start with a concept, but in unlike the financial option, right? Unless the option on call and put options on the stocks, right? The real option exists in real physical business sense, meaning you have an option to build something in case the demand even if the demand is not there yet, but in the future, right, if the demand is going to be significantly increasing in the future, but that's no guarantee. There's just a probability it can happen. But then with the current plant capacity at the original onset of the capital project, right? You cannot handle that additional demand because the capacity is, capped at certain maximum. But although there is no immediate, extra demand, right? If you pre-build, right, excess capacity, which would be an investment at this point, but which may not exactly result in a harvest, right, or cash inflow in year one, but in case in the future, if the demand surges, you need extra capacity, right? So that's whether you build it already in the or prepare a space, even if you don't put any machine and equipment there, but if you at least prepare a space for that, right, it will come in very handy when the demand explodes. But of course, there's no guarantee that it's going to happen. But that's an option. In other words, you can have this going forward along with you, or you may not. Again, think about it. That's what the call option is all about. If you think about it, isn't it right? You buy a call because you're thinking that the stock is gonna go up, and then you think the price is too high. I mean, currently, even currently, uh, the current market price is just too high. It's overvalued. So you're betting that the price is gonna be adjusted. It's gonna come down. But what if it doesn't come down? If it just keeps going up because the market's irrational, then you have missed the timing, right? You have missed a chance to buy the stock at a lower price. And a lot of this can happen, right? This happens actually, That's why you buy call option, right? If you buy a call, then it gives you uh, the right to exercise it. And when you exercise it, uh, you buy it at a specified lower price than um, the actual price, of the stock when the price is up, after the price has gone up, right? But if the price actually goes down, you don't exercise this option, right? You just let it expire without exercising it. Of course, then uh, your option is not for free. It costs you. You pay for that option. Uh, you will incur that loss. But if the price goes up exponentially, then the option is the more the option will be in the money, right? So that's what the option is all about, and it's the same thing here. So real option is frequently this occurs frequently in capital budgeting. In other words, uh, the real option, right? And generally, real option generally increases the project's expected net present value. Okay, and there are like four types of options, right? Um, I don't know why the abandonment uh, first came up, but I would start with the expansion option. Expansion option is an option to expand the production capacity. So it often requires little or no early commitment, but it should be planned. It should be planned in whenever possible. Investment timing options permit delaying investment until you're more certain about surrounding issues, right? For example, but you have to pay for uh, a lot. Lots of times, if you make a down payment or deposit, right, before you and what is that down payment or deposit? I mean, you're not ready to buy it yet, right? But by making the down payment, it gives you the option to delay your decision. In other words, as long as they have your down payment, they cannot sell it to someone else, right? If they sell it to someone else, then they will be obligated to, refund that down payment, uh, or sometimes even penalty on top of that, right? I mean, if you have a deposit, then you are holding it for, let's say you make a deposit and you are asking the seller to hold it for uh, 3 days for you, right? And then during those 3 days, as long as they have taken the deposit, they can sell it to someone else. So it's an option. But once 3 days are up, right? Uh, you either buy it, or if you don't buy it, then you'll just give up that uh, deposit, right? Of course, in that case, it will be a small deposit. It won't be a huge deposit, right? That's investment timing option. And the flexibility option is an option to observe ability to respond to changing business conditions. Also, it's like making the deposit there's also something like, it can be also an example of flexibility option, right? Now, what is an abandonment option? Abandonment, you can abandon the project, right? So the abandonment, my mouth is so dry and tongue-tied. I'm so tongue-tied, so it's really difficult to enunciate it. Abandonment option can increase expected net present value, and it can lower the risk. It's a contractual obligation that can make abandonment tough, right? So through the contractual obligation, right, the seller of the option, right, or the because there would be two parties to this, right? I just called it seller of the optional, but it could be the other party in the contract, right? So due to the contractual, obligations, it can make abandoning actually very difficult. So it makes early planning an imperative. Okay, so here's an example of real option, right? Consider Wingfoot Shoe Company's situation of the possibility of excellent demand is as described in example 12.3. Okay, so that was what? In year 2, excellent. Year 2 and 3, demand will be excellent. Then if the demand is taking off and demand becomes excellent from year 2, then what do you need? You need additional $1 million investment for capacity expansion, right? So in that situation, is a real option present? Part A, right? Question part A is, part A question is real option present? B, yes, actually the answer is yes. B, suppose space at Wingfoot's plant is scarce and room for an expansion is available only at 0.5 million at the project's outset. Now think about it. Expansion would only require 1 million if there is space already, right? If there is already a space, all you need to do is put in more equipment, right? Put in more machines and equipment. And that would cost 1 million, right? But if there's no space, then you cannot put in equipment and machine. There's no space for it, right? But then to prepare a space, this should be pre-planned. It cannot be something, additional investment of 1 million for equipment and machines can be done in year 2, right? It's just, money capital, right? But look, extra space cannot be just built in year 2, right? It takes time. So such a space, extra space, must be pre-planned, right? It must be already included in the original plan. And if you include it in the original plan, this is an option, isn't that right? This is a why, clearly an option. Why? Extra space, you have to invest $500,000 to include extra space, but this extra space will be useless if in year 2, right, the demand doesn't turn excellent. Make sense? So now, in other words, the project's initial outlay will increase by $500,000 if the expansion option is included, right? If the demand isn't excellent, then money will be simply wasted. Should the expansion of the space expansion space be purchased under the conditions in example 12.3. So let's see. Yeah, 12.3. So here, this will take some time. I would say this will take. So I don't think we can do this. We can do this example within the given time. So I will. So we'll call it a day here, and we'll continue this example in our next class. Okay. All righty. I'll see you in our next class. End of video.